Good evening. This is Ken Long from Tortoise Capital Management with a case study on the core and turbo technique using the regression line crossover strategy. And we're going to look at symbol CLF, Cliffs Natural Resources, one of our favorite trading targets. And this is a case study from 2015-02-02. So that's February 2nd, 2015. The swing trade pattern we're going to look at is a Z trade that comes out of the rlco framework, and we're also going to use an rlco set of intraday patterns and then look at a continuation. First, we want to start off with a sense of where the market is. This is a look at our market health check. It looks at daily charts. It looks at 10, 20, and 30 days of look-back period. We're in sideways volatile conditions, meaning that we are much more prone to take short-term intraday trading profits given the nature of the market, since the things that we're trading are strongly correlated with the market, and the market's sideways and volatile. There's very little follow-through. You can see that in the past 30 days that we've basically been in this sideways channel inside the river, which is this dark blue shaded area, 30 Bollinger Band plus or minus 1, the floodplain plus or minus 2. You can see that the red ribbon is the dragon. That's a 10-period Bollinger Band plus or minus a half. That gives us an indication of when the river might change. You can see all of price and the dragon are all inside the river, and everything's flowing sideways with a slightly downward bias over the last 30 days, as shown by the 30-period regression line here. So we are very inclined to take one-day short-term profit targets. Now, we like this particular market condition here as we're testing a triple bottom at this support level at 199. We've noted that if 199 and 197 fail here at the bottom of the river, then it's a short leap to the 200-day moving average and a potential crash below, and a big move to the downside if those two support levels fail. So we're aware of the possibility of a short-term correction, and this is from 30 January. This was the day before February, so this is our market preview the night before. You can see the sine wave looking line is the that is the slope value of the 30-period regression line, shown here by the central black line. You can see that it's sloping downward. It's negative because it's below this dotted line at 0. In fact, it's come all the way down here to minus 0.2 slope. Historically, that's been a significantly steep downward look, considering the last 5 years and the worst 30-period slope values. That's among one of the worst. It's more than a standard deviation below the historical average. So that tells us that we are already starting to push significant downward sloping moves here in this bull market. And so we're going to be aware for either a breakdown to the downside, which will be a sharp one-day move, or a strong rebound if these three support levels that we're testing actually holds and rebounds, and we have an expectation that it can get to 204 and then 207 and then 210, all within the normal bounds of this kind of oscillating market. So we've got an oscillating market that's oversold. It's at a support level, could give us a sharp one-day reverse, and then that would support symbols that we're typically interested in. So now we're going to drill into our daily report for that day and look at a page on the auto framer, which happens to look at targets on the basis of their trade location and estimates a reward to risk using trade location, a 10-day high for a profit target, using a range risk, meaning that we would enter mechanically 5 cents above yesterday's high with a stop 5 cents below yesterday's low. We would treat that as our mechanical risk. And we would use a retest of the 10-day high as our mechanical price target or reward, and we would then compute that reward to risk ratio in this column. And we're looking here at a combination of Dow 30 industrials and the ETF 30 liquid ETFs that represent the global world market model, plus a few candidate targets that we like to trade. Cliff is one of those, and here is why. Cliffs Natural Resources is CLF. It's in second position. On Friday, it closed at 642. The high of the day, looking at reference data, was 646. So 5 cents above that would give us a mechanical entry at 651. 5 cents below the daily low would be 5.99, so it's a 52-cent risk. The test of the 10-day high would get it up to 9.39, and that's $2.88. So when we compute the reward of 2.88 divided by the risk of 52 cents, that gives us a 5.5 to 1 reward to risk ratio, which is pretty favorable. I want to also draw your attention to this ATR percentage, a measure of daily volatility. CLF trades with 12.2% ATR percentage, which makes it an extraordinary candidate for intraday trading. It's very liquid. It trends in multiple days once it gets going, and the intraday moves just on their own regard are very very lucrative too. So that makes it one of our favorite symbols for trading. It's strongly correlated to the industrial and mining sectors, and so when those sectors are moving, CLF is a natural place for us to look. So we'll take this table and use it to generate a list of interesting trading targets to frame out. I like starting just from the top and working my way down, and so we went and framed CLF's Natural Resources with its 5.5 to 1 reward to risk ratio. You can see just from this screen alone that we've got about 15 interesting candidates just within our relatively narrow range of symbols. All right, so the next thing that we look at is on the actual day when we trade CLF, on 2 February, we're going to see that the market actually held support here at 199 and gave a minor move up, getting back into the river. And so the day we actually trade CLF, the market was moving generally in our favor. When we came back and framed that trade, this second to last candle is the day of framing. That was the close on Friday, 30 January. And you can see that CLF had moved from 9.25 on these daily charts 6 days down in a row to 6. Yeah, that's right. That's a 33% sell-off back to a support level that has historically held. And so our idea is that we would enter at the green line 5 cents above the high, approximately at 6.50. We'd have a range risk down here at 6. That gives us about a 50-cent risk from the green line to the red line. We would auto short this if it had failed through 6, because it would give us more continuation of exactly this kind of move. But we would go long if it gets above the green line, and our price targets would be here at 7.50 in the middle of the dragon, the north shore of the dragon, and the far side of the river at 8, 8 3/4 at the floodplain. A retest of the previous 10-day high at 9.20, and then all the way out to 3 standard deviations on the daily up around 9.25. So CLF is actually in a critical state, which is something we like to see, where we can frame a positive reward to risk ratio, an attractive reward to risk ratio in both directions. And then we just wait for the market direction to take us in. So on that day, the market actually moves up. CLF moves in tandem with it, and is even better than the market. So that gets us into this trade on a mechanical basis around $6.50. Now I want you to notice just how large the ranges are. We call this a signal to noise ratio. These are the real bodies are very large in CLF, and so it will feature large intraday directional moves, and so that becomes an ideal candidate for core and turbo. Now we're interested in this one on a Z-trade candidate because it's outside the river and now has re-entered the river, and we look at the far side for our 2 to 1 reward to risk ratio. So the fact that it has moved from outside the floodplains all the way to the other side gives us the alert, and we'll cover that in the day trading workshop called the Z-trade. But that's why we're interested on a swing basis. Now this is a fine swing trade setup, but because it's a sideways volatile market, this is one of those where if we get well started on day one, we'd like to be able to get some more of that and maybe keep a piece and start cashing profits along the way because of the higher probability of failure to follow through because of the market condition itself. So let's see how we work this core and turbo piece together. The following day, this is the opening on the 2nd of February. You can see this was the close on 30 January. That was the Friday. We get an open at the previous day's close. We get an immediate sharp move up. And this is where we play our first turbo as it gets through the dragon and then out to the edge of the floodplain where we've got a strong move up. We make our turbo entry here with the intraday type of a trade at 655 with a 20-cent stop down here just to get our position sizing in. We call that turbo 1 because we're using intraday size of risk. We get the mechanical entry up here around 650, 655, and that's going to have a 50-cent stop, so that would be just off the chart here, well below the price level that held the previous day. So this would be down here below the edge of the floodplain, so quite a wide stop. So now we've got two positions, and the idea of the core is that this is position size with 50-cent stop, and we would treat that as a overnight level of risk. So our position size for that piece will be smaller. If we're using a 20 or 25 cent for the intraday position here, then our position could be twice as large as the core, but this is one that we have to liquidate at some point during the day in order to keep our overnight risk at manageable levels. Well, this thing works. It starts riding the edge of the floodplain all the way up. It finds and keeps support at the dragon on the pullback. At this point, we've got 2R in hand and some momentum as it leaves the dragon again, and that's where we would enter our second position. But now we're starting to get towards lunch. We have the second position is got money in hand. We get a pullback in here, and because we're entering into lunchtime and the market is starting to slow down, we go ahead and cash turbo 1 and turbo 2. We keep the core position on. It's got a 50-cent trailing stop, which would now be down around 635 at this level. This turns out to be the the stop level that we're using intraday to protect the core position. Now what we get after the sell-off is a drift back to the Bollinger Band mean and a volatility pinch, and because it's held support here twice and the Bollinger Band pinch, we now have a sideways quiet channel. We play the breakout of the river here in the last hour, hoping for a pop, and sure enough, we get a pop. We get our entry around 685. It runs all the way up to 720. We'll take the exit here around 710, and then cash a small piece on the turbo here. So now we've cashed 3 pieces on the intraday, which is enough of a gain to fund the overnight holding that was established with the core. So now I feel like I've offloaded my core capital risk, and I'm now using markets money that was earned intraday to fund the overnight risk dollars in the core position. So I feel like I'm reducing my portfolio risk at that point. So now we're holding this piece overnight, and we want to see therefore what happens the next morning. And so what happens the next morning, this blue line is the close here, and now this is the open. It moves from the Bollinger Band mean and opens at 3 standard deviations on the intraday up here at 735-ish. It gives a little bump up and then starts selling off. That's enough reason to cash the position here, and so I cash the core. And now I'm going to use a Z trade or an Anderson regression line stretch for those of you that know that technique. But the Z, more than 3 standard deviations above the mean, reverses, comes back, so I sell at Z plus 2. My target is the far side of the river. This thing collapses all the way from 735 down here to 650. That's an 85-cent move on a $7 stock. That's a 12% intraday move. So we're selling this here with a stop at 1 standard deviation. We've got 1, 2, 3, 4R in hand. We give 1 hour back, and there's a 3-hour move on the intraday short just within the opening 30 minutes on this very liquid stock. This is one of the reasons we love CLF, because this is a typical move. This was an average ATR percentage move on the intraday range, and we get that move within 30 minutes, and so that makes it an attractive candidate. Now, the rest of the day, it did really not much of anything except grind downwards. There was nothing really to make it attractive. This was a day when the easy money in the market, if there is such a thing, was up because the market was in its second day of buying. CLF rejected that market's momentum. This was people that were selling CLF all day, and so there was no reason to get interested in the long side. So this was a a 2-day sequence in CLF where we combined the best of the swing trade patterns and the core holding, along with some turbo intraday techniques that allowed us to cash some money when the market was favorable, to offload some of our risk in the portfolio from seed capital to markets money, and a way to play the overnight trade and then be ready with our knives sharpened in the morning for either a continuation pattern in the same direction as the swing trade, or in this case a large gap up and then a sharp reversal that allowed us to do an intraday Z trade. So that's how we use our reports and our patterns together, combining intraday and swing trading. In this case with symbol CLF. Thank you very much for your kind attention. Keep your risk measured and your powder dry.